Here's a company that's going to require you do quite a bit of research. If you're even thinking the slightest, you might invest in Cisco that reported earnings today. Cisco, not SYSCO, the food distribution company that we reported earnings for a week ago, not even a week ago, 3 days ago, 3 business days ago, something like that. This is Cisco CISCO. This is Cisco in the Silicon Valley Cisco. The networking, hardware, telecommunications, high technology, highfalutin type of a company. This is going to require a lot of research if you're going to venture down this path at all. I'm just going to put that out there. This is not a company that you step into lightly. I can tell you that a lot of the market spaces that they're in are very, very specialized, and they're going to be something that probably even some very skilled advisors might not be able to break down for you. I would suggest if you're going to get into Cisco or anybody that does network, hardware, any kind of data storage and switching and all the big, server stuff, it's very, very, very convoluted, and I want you to do your due diligence because I want to see you do really well. Don't we all? Don't we all want to do really well? So net income was down 14% year over year. That's clearly not very good, especially when you consider that Cisco is definitely one of the top dogs in this fight. They're not the top dog, but they're definitely right in the thick of things. They do have a lot of competition that's been coming in. Everybody kind of branches in when you get to these high-tech companies, branches into other people's, this is your sector, this is your industry, but I kind of come in here a little bit, and because everybody's got to move. You eventually cap out or reach a point of diminishing returns. You've made this sector so it's so saturated now that you need to go somewhere else with your business just to show shareholders. And Cisco kind of has a lot of other companies that do encroach on stuff that they do. So while there was a point in time where Cisco maybe was the dominant force or right there with it, they've fallen back. They're top 3. They're doing really well. But some of their numbers say that this quarter wasn't the most impressive. Switching down 9%, NGN routing down 9%, data center down 4%. Their security and wireless up 3 and 5% respectively. A lot of the departments are down. They said in the conference call they were going to switch the names of some of the departments to better. They're probably trying to merge some of the poor performing departments with some of the better performing departments that are maybe on their way up, so that they can better hide some losses in future quarters. Because it's not fun reporting a bunch of different departments where you've got 4 or 5 of them that are all pulling back because of competition in the market space or just saturation in the market space or whatever it happens to be. Maybe you're just doing a bad job at Cisco. I doubt that. Book to bill ratio, though, is above 1, and they made a point of pointing that out in the conference call as well, because I don't think with EPS, I don't know if we covered this, EPS 61 cents, that came in line. That actually beat Cisco's EPS that they were even forecasting by 1 cent. Revenues of $12.13 billion. That's down 4% year over year, but it's 60 million over what the estimates were. They're not crazy beats. Well, the ones a beat only on Cisco's part. Analysts had it at 61 and it came in at 61, but it's not a crazy beat on the revs, and the revs are down year over year. So, but the book to bill ratio is over 1. So your book to bill ratio is basically you get orders booked in, but it's that you're actually billing on the other end. What's the ratio? And over 1 would say that they've actually got more orders still to fill, that they're not capped right out. There's more stuff in the pipeline. They can't fill all the orders that they could bill right now because they're doing so well. There's such good demand, they're saying, for it. Whatever it is that whatever department it is that they're saying is definitely holding the workload at this point, because Cisco's obviously showing a lot of down numbers. So either they've ramped down production considerably to bump that book to bill ratio up because they are still one of the big players and people are going to use Cisco for a lot of stuff, or there's only a couple of departments that are really keeping that up, because we see a lot of the departments are down 9%, switching and NGN routing. Those are down quite a bit. Earnings call was what it was, to be honest with you. I'm shocked. I enjoyed Target's earning call a lot more than I enjoyed Cisco's. If you're going to be investing in anything close to Cisco, I would definitely recommend please do your due diligence. Talk to a licensed professional financial advisor. This is one of those companies where if you're not reading and doing a lot of research and really trying to understand how everything intersects with everything else, it can get away from you, and you're basically just trading on a name then at that point.